Hi, I'm Jacob Hornberger, president of the Future of Freedom Foundation, and welcome to this week's Libertarian Angle, the show that brings you all the principled case for the libertarian philosophy. I'm joined by my co-host, Richard Ebeling, professor of economics at the Citadel. Richard, good to see you again.
Good to see you and to be with our viewers and listeners.
All right, Richard, you're the economist, and you've authored this great book for the Future of Freedom Foundation called Monetary Central Planning in the State, which I highly recommend to everyone. And I want to raise an issue with you that has long been part of monetary policy, at least as part of the discussion of monetary policy. But it's now being raised again in light of the Federal Reserve's policies here to raise interest rates to combat inflation, which of course it is responsible for. But I want to discuss this issue of a fixed rate of inflation. Somebody wrote an op-ed recently, I think it appeared in the Wall Street Journal, that said that we ought to increase this fixed rate of inflation, this target rate that the Fed is shooting for, which is 2%. The op-ed writer felt like we needed to raise it to 3%. So I want to raise this issue with you, not only in terms of that kind of scheme of monetary central planning, what the Fed should do in terms of an ideal rate of inflation, but also in the overall context of what the real libertarian solution to this monetary debauchery is. It seems to me that when you have a fixed rate of inflation, whether it's 2% or 3% or 4%, that you've got all the problems that come with inflation. Now, when I define inflation, I'm not talking about prices rising across the board. I see that as a consequence of inflation. The inflation is expansion of money and credit by the Federal Reserve, by the central bank. They're inflating the money supply. They're expanding the money supply. And then that monetary debauchery, the debasement of the money, is reflected by rising prices across the board. Now, when we talk about inflation, one aspect of inflation is the perversion of investment decisions or consumption decisions too. That we've often talked over the years about how inflation corrupts the price system. And so the price system is the way that people calculate, should I invest in this? Should I expand my business? And so consumers make their decisions accordingly with the price system. And that when you corrupt this price system with an inflated money supply, people's investment decisions and consumption decisions are all out of whack. And that this is the primary reason why we get this booms and busts, that the Federal Reserve is inflating the money supply. They create this artificial sense of there's a big boom. Consumers are spending. Businesses says, oh, we need to expand operations. They go out and borrow money. They build warehouses and additional office space. They hire new workers. And there's nothing to sustain it because it's all based on this inflated money. And that's when the bust comes. Well, and so we see this, especially like in countries like Venezuela, where the inflation rate is 100% or higher, or Zimbabwe, where it was like 1,000% or so. But it seems to me that the same principle would apply, albeit at a lower level, if your fixed rate of inflation is 2% or 3%, that you're still going to get a certain amount of corruption or perversion that exists when inflation is at a much higher level. So let's start there, and let me get your feedback on that.
Well, I certainly disagree with the fellow who proposed a 3% annualized price inflation rate. I personally think it should be 2.978% because I don't like to go overboard with things. Okay. I beg the viewers and listeners to allow me to wear my economist hat, more specifically my Austrian economics hat, and sort of deal with certain fundamentals that are assumptions or taken for grantedness behind even talking about these things. First of all, when you say a 2 or even 3% level of targeted annualized inflation, how do you know what the 2 or 3% is? The method by which this is done is through a price index. That is such as like the Consumer Price Index, which comes out every monthly from the Bureau of Labor Statistics. Now, how is it? Now, first of all, there is no such thing as a price level. There are individual prices. There's the price of hats, bananas, shoes, pairs of glasses, earbuds for Hornberger to wear and listen through while we're doing these things. And each of those goods has their own particular price or set of prices in their corners of the market. So to determine an average, prices are rising in general by 2%, 3%. You have to do a survey of these prices. Now, it's impossible to have a survey of all the goods. And so what the Bureau of Labor Statistics says, they have people, thousands of people, paid for through your tax dollars, because the Bureau of Labor Statistics is a government department, whose job is to survey what prices are doing in thousands of businesses across the country every month. And it's a selected group. So what they do is they ask the question through supposed surveys, what does the average urban family made up of, I used to say a husband and wife, but you're not allowed to say those things anymore, two people living together who may be married or not, and 2.5 children. Because if you work out how many children this family has, that family has, 3 there, 1 there, 4 there, it works out on average, the average American family has 2.5 kids. That half never grows up. And you ask, well, what do they consume? And that's done through a survey too. What does the average blue-collar urban family consume? So many quarts of milk, so many loaves of bread, so much on entertainment, so much on gasoline and heating, so much on these categories of selected goods. And so there you have what's in the basket. And then they weigh it. That is the relative amounts. Every week, 4 loaves of bread, 3 quarts of milk, on average in general, over thousands of households. And you're then now tracking, here we have a basket of goods with selected goods in it, in their relative averaged amounts. And now we're going to watch the prices every month. And that's going to tell us what on average prices are doing in general, and therefore what is happening to the cost of living. Obviously, if the basket of goods rises on average by some percentage, the cost of living has increased by that much, which means either your money income rises enough to keep buying the basket at that average higher level, or you're falling behind. Or you're someone who gets salary raises increase greater than what the basket is rising on average. And in their way of calculating, you're having an increase in your standard of living relative to what inflation is. But that's how they're tracking this. And so they say, well, it should be 2% or 3%. Why? Because it's argued that there are certain prices in the economy, particularly wages, that are, quote, sticky downwards. That is, workers are happy to accept increases in their wages, money wages, but they're very reluctant to take cuts in their money wages, even if taking a cut in their money wage might be the means by which they retain their job in bad times when the employer can't afford to pay as much. And therefore, if inflation slows down or isn't existing, and bad times hit, and businessmen have to cut back production, but workers will not adjust their wages, unemployment arises. So better to always be having a little bit of inflation, so that with rise in wages and wage demands, there's also a rise in prices of goods, and therefore you're always sort of maintaining employment. Now, even if you want to deal in the averages, there's a famous Swedish economist called Knut Wicksell. He lived in the late 19th, early 20th century, very closely associated with, quote, the Austrian school. And he pointed out in one of his books that the idea of building in a 2% price inflation, or any rate price inflation, as an attempt to keep a certain stimulus going in the economy, is like the fellow who's worried about missing his train to work every morning, and therefore he sets his watch ahead not to be late. But he knows he has set his watch ahead, and he'll build that in, and he still will constantly be dashing to try to catch it. Now, if everybody knows that prices are going to rise by 2 or 3% a year, you're not going to have prices rising relative to wages. Workers and their union representatives, to the extent that unions have this power of wage negotiation, are going to build that into it. So there's no extra stimulus in the economy at all. But the deeper problem with this, which you were alluding to, Jacob, which is very not alone, but unique and often emphasized by the Austrians, is that when there is a monetary expansion in the economy, prices do not rise at the same percentage and at the same time. There's an injection effect. Now, what the hell does that mean? The analogy I like to make, Jacob, imagine that there's a pond of water and you drop a pebble in the center of the pond. From that epicenter, the place where the pebble has hit the surface, waves will be sent out and will hit the shore, and then the waves actually will start coming back a bit. That's what happens when there's an injection of new money in the economy. It could be just fiat money that the government were to print up and directly spend, let's say, on welfare payments or war expenses. Or it can be, as is basically the institutional way it is done in our central bank, money is created by the Federal Reserve. And what they do is they buy government bonds, though they now buy a lot of other things as well, mortgage-backed securities and other things, and they create new money on the basis of this. And this new money then appears on the balance sheets of banks where the money is deposited. And this money is then lent out by banks at artificially lowered rates of interest, because now with extra money to lend, the banks can only attract more borrowers by making it less expensive to take out a loan to attract them. And the money then is lent to those who undertake these loans. They spend the money on certain things. That additional spending increases the demand and the prices and the wages of certain groups in the society. The money passes into those people's hands and they spend it on the goods and services they desire, putting upward pressure on another set of prices and wages based upon how they expend their extra money. And then the next ripple and the next ripple and the next ripple. So changes in the money supply send out sort of a pattern temporal sequence, a time sequence of affecting different prices and different wages and different profitabilities of producing different goods at different times and in different places in the economy. There is no average. So that even if the Federal Reserve was set a target, 2% price inflation each year, 3% price inflation each year, it will not be neutral in its effect. Because regardless of what that average that they're tracking may do, the money's injected somewhere. It's affecting some prices before others. Relative relationships of profitability, loss making, more job opportunities, less job opportunities, greater employment opportunities, more profits to be made by making these products as opposed to those products will potentially be distorting all the real underlying microeconomic relationships of the economy. So it is not a guarantee, a guarantor that there will not be the same types of distortions, imbalances, mismatches between different types of supplies and demands and negative feedbacks through that process that you were alluding to. So, but why do they want to do this? I mean, what's the mindset? And ultimately, which was part of your opening remarks about discussing the very nature of the system itself, there is the presumption that the monetary system has to be managed by the government, that there must be a monetary central planner, and that he knows and will decide on how best to see that there's just enough money in the economy to hit some target or too much money to hit that target, and how the money should be introduced through influencing short-term interest rates, an attempt to influence longer-term interest rates. And now everything is politicized by the government in the sense, well, it's not just trying to stimulate, investment in general, but politically correct investment. The Federal Reserve perhaps should, and their influence on banks should be to prioritize. Yeah, loans are made cheaper now, but it should be for business investments connected with climate change responses or diversity and inclusion in what's produced and who's employed. It's totally politicized, or at least many want to even more politicize it than it is now. And the fact is that the central bank, no more than any other central planning institution, has the capacity to assure stability, smoothness, continuity, balance in the monetary and financial sector, any more than in the old Soviet Union. the central planners and what was called Ghost Plan, the central planning agency in Moscow, could successfully know what to produce, how to produce, what amounts, with what relative combinations of resources, to do it in an efficient, productive, and Soviet citizen consumer satisfying way. It can't be done. So what does that mean for the monetary system? It means that the long run goal, the target of what a friend of freedom should want, in my humble opinion, a classical liberal, a libertarian, is the end of monetary central planning. Money and the monetary system and the banking system should be fully and completely turned back into, or for the first time put in, the hands of the market. Money should be depoliticized and privatized. People should decide what they want to use as a medium or media, that is, different monies for different purposes, media of exchange. They should decide what banks they want to deal with. The bank should decide what they should hold as cash reserves against the liabilities to depositors. The government should not be managing and mismanaging these things. And in my humble opinion, if the monetary system and the banking system was effectively and fully placed back into the private sector, where it has partially been in the past, but never fully been in the past. Until that is done, we will have these booms and busts, misallocations, and politicized things. Let me conclude my comments on this by quoting a German free market economist named Gustav Stolper. He was very well known in Germany in the 1920s and early 1930s. He was the editor of a newspaper, but being Jewish, he had to leave Germany in 1933 for obvious reasons and came to the United States. And during the war, he wrote a book called This Age of Fable. And in one of the chapters is on money and banking. And he says, the friends of liberty have never understood completely that the moment that government took over the monetary and banking system, the cause of freedom was lost. Because there is nothing short of actual confiscation of people's property that is more destructive and more damaging to a free market than a government-controlled and managed monetary and banking system.
Yeah, well, you raised a lot of good points, especially that last point. I mean, it's a tax. I mean, what happens is that the government wants to fund its ever-growing operations, but it's reluctant to raise taxes to do that, direct taxes like income taxes, because people get mad about that sort of thing. So they just resort to the printing press and say, well, okay, we got to buy that tank over there, but we don't want to raise taxes because that's going to upset people. So we'll just print the money to buy that tank. And then as prices start going up, people don't know what's going on. They just see prices going up and they blame the employers and the producers and the gasoline station owners, and, oh, you greedy, rapacious capitalist swine, you're raising your prices. And they don't realize that it's just a reflection of the monetary debauchery. It's the only way that monetary debasement can be reflected is rising prices across the board. And you raise a good point about the stickiness of employees' wages. That, when we had the gold coin, silver coin standard, which I consider the second best system, our American ancestors rejected paper money completely. That we never had paper money in this country. We often hear, oh, it was a paper money standard backed by gold. It was nothing of the sort. There's no authorization for paper money in the Constitution. In fact, the states are prohibited from issuing paper money. They call them bills of credit. That was what was paper money. It was a gold coin, silver coin standard. That was the official money, and governments had the power to borrow notes, bills, bonds, but it was always understood that this was not money. This was promises to pay money, real money. So what was happening is throughout the 19th century is you had a relatively stable monetary system. Now there were gold discoveries, of course, out in California that would naturally inflate the supply of gold, which would have an effect. But overall, when you look at the 19th century, all the way up to the time the Federal Reserve was established in 1913, it was a relatively stable monetary system. And it was one of the reasons why there was so much prosperity in the United States, along with a lot of other factors, no income tax and so forth. But when you have that kind of system and you have tremendous productivity, because this century, especially the latter part of the 19th century, was characterized by tremendous prosperity and production of wealth. Well, what's going to happen then? Well, prices are going to naturally start dropping because your money's buying more. You've got stable money and you've got increased production, which means your money's going to be buying more, and that's going to be reflected in prices gradually coming down. And that upset the status. They thought this was a bad thing, that prices would come down. Well, it's not a bad thing with respect to consumers. I mean, when your money's buying more than it did last year, that's a good thing. And then another point I wanted to make was with respect to your point about monetary central planning and the central planner. You talked about how do they determine that ideal rate increase in the money, 2%, 3%, 2.97. It seems to me that another problem they have is how do they determine what money is? I mean, from my understanding, there's all kinds of definitions of money. There's M1, M2, M3, M4, M5, and so forth. Which one do you choose? And then the other problem is these people are just guessing. They're central planners. They don't know how to, let's say they arrive at some ideal increase. Let's say it's 4%. And they arrive at some ideal definition of money. How can they be sure that what they're doing is going to hit that target? Suppose they overshoot and they hit 7%. Okay. How do they measure that 7%? As you said, we're looking at a basket of individual goods. So they have to come up with some agreed upon measurement. And let's say it hits 7%. Now what do? Well, they've already exceeded their target. They've already violated their own rule. Now they have to contract, but to a bigger extent, to get back to 2% or 3%, whatever it is. And how do they do that? And there's always a time lag, as you know, Richard, between the price effect and the expansion of the money supply effect. So you've got this bouncing back and forth with the booms and busts and perversions as well taking place here. The ideal system, as you pointed out, is a free market system. I mean, that actually surpasses the gold coin, silver coin standard, because as sound as that system was, the government was running it. There was problems when they had fixed exchange rates between gold coins and silver coins and so forth. One would drive out the other when they set the exchange rate the wrong way. The free market produces the best of everything. This is how we can build on what our ancestors did, especially with our increased knowledge of Austrian economics and so forth. This is Hayek's notion: denationalize money, just separate money in the state. Let the market determine what money is. It may be gold coins, silver coins, bitcoins, American Express banknotes, or whatever. But the market would ensure that you've got the soundest monetary system in history, one where the government is precluded from jacking around with these interest rates and money supply and targeted figures and so forth.
One other thing that tends not to be mentioned in these discussions is that even if you use that 2% annualized inflation rate, your basket is going to rise at an average of 2% a year. Within about 20 years, if you just constantly did that year after year, a dollar, that is the purchasing power of a dollar, would lose about 50% of its buying power. So just 2% lowers the value of the dollar in your pocket by 50%, because it's compounded. 2% of this amount, and that's 2% of, you start with 100, so 2 years later it's 102, and then it's 2% of 102, and then it's 2% of whatever that next number is, and the next number. So it's accelerating in that sense, and the result is that because the percentage becomes larger of the bigger and growing base, and so the result of this is that in about 20 years or so, what the dollar that bought $1 worth of goods today will only be buy 50 cents worth of goods 20 years from now. So it's not even by that standard, it's not costless.
That is a great point. Absolutely great point. Because if you look at the trajectory of the value of the dollar compared to everything else, let's say gold coins or silver coins, which was the official money, from 1913, when the Federal Reserve was established, all the way to today, there is a downward trajectory. I mean, the value of the dollar has just gone progressively down. if you compare the value of gold, let's say at 1913, it's pretty much the same in terms of what it can buy today. You know, 1 ounce of gold in 1913 could buy pretty much what 1 ounce of gold today can buy in terms of dollars. But it's the value of the dollar that has progressively gone down. I mean, they have plundered and looted us, not just with income taxation, but also through this monetary debauchery. And this is what all too many people just don't recognize, is how much more wonderful life would be, economically speaking, if the government had never taxed all that productive capital away in terms of income taxation, but also had not confiscated all that wealth through monetary debasement. Because like I said earlier, it's a tax. And your point is great, that even when you have this 2 or 3% fixed rate, it's going to gradually plunder and loot people, albeit to a lesser extent. But as you point out, over a 20-year period, if you've lost 50% of the value of your money, you've essentially been taxed by that amount. And so even at this fixed rate, you're still talking about monetary destruction and destruction in terms of people's standard of living.
Yeah, I just want to sort of hark back to an earlier point that you made about an environment in which goods are falling because of greater output and productivity. People sort of poo-poo that, particularly mainstream macroeconomists. Oh, deflation is bad. It's a symptom to saying the economy is going into recession or depression, rising unemployment, falling output. But there is a period of falling prices that was a dramatic episode of general prosperity. And that was the United States between 1865, when the Civil War ended, and the beginning of the 20th century, about 1900. During that 35-year period, prices fell by about 30%.
Wow.
But at the same time, virtually all of that fall in prices was due to America's Industrial Revolution. That was our Industrial Revolution. Before the Civil War, we were basically an agricultural and light industry economy. Our industrialization came in the 3.5 decades after the Civil War. Greater output, increases in productivity, falling costs of manufacturing, innovative of new and better products, with the result that in that 35-year period, prices had fallen about 35%, which meant that it didn't have a negative effect. It meant that each dollar in your pocket, day after day, week after week, year after year, was now buying more real goods and services. Now, I should mention that at the same time, people's wages were rising in both agriculture and industry because of rising productivity. The value of each worker was rising relative to the much larger capital investment. And as a result of this, if you add together both the real standards of living improving due to falling prices, that is, your given dollars buying more, and the fact that on top of that, your money wages are rising so that you have more money to buy even more at those gently falling prices. And we're talking about on average here, right? On average and in general, the real value of people's income rose by almost 75%.
That's incredible. I mean, you hit home with me.
And if I could just say, and Milton Friedman, who usually was considered the advocate of the monetary rule. Oh, you keep the money supply increasing at 2% a year to keep a balance. Like these people want that inflation rate. In one of his essays, he said, he made a point of saying is that it was demonstrated that deflation is consistent with prosperity by that period following the Civil War. And he talks about it quite clearly in his famous monetary history of the United States.
Well, that period, it's funny you mention it, because that period from around 1890 to about 1910 is my favorite period in history. I mean, if I had to choose to live in a certain time, that would be it. I mean, okay, they didn't have air conditioning. They just were bringing cars into existence. But in terms of freedom, I mean, there's nothing that matches this deal. I mean, I think the only regulation at the federal level was the federal antitrust law that came into existence because of the status in 1890. But if you look at this period, there's no income tax, no Federal Reserve, no central bank. Gold and silver coins were the official money, sound money. Corporations were issuing 100-year bonds, and people were buying them, feeling very confident. Oh, nothing's going to happen to the value of my bond. It's payable in
Right.
gold coins and silver coins. No immigration controls, no drug laws, no Pentagon, no CIA, no NSA, no FBI, no systems of public schooling, except maybe in Massachusetts. It was an incredible period. Virtually no economic regulations. Inventions were coming every day. I mean, it had to be a terribly exciting place to live. You know, automobiles, a deal, the washing machine, all these inventions coming due because people could keep the fruits of their earnings, massive accumulations of capital. To me, it had to be a very exciting time. No foreign wars, an exciting time in which to live.
Well, I'm picturing Jacob Hornberger in 1890. Yes, trudging out to the outhouse in the back in the middle of winter with the blizzard snow, or in the heat atop of the summer, and no air fresheners available to buy to put in the outhouse. I'm picturing Hornberger walking through the streets and stepping in that horse poop, because it's horse-drawn carriages, and you never know where you're putting your foot down. Yes, yes, those were the good old days, Jacob. Those were the good old days.
Well, I'll tell you, I forget who presented this dichotomy, but somebody said that if our philosophy, the libertarian philosophy, resulted in greater poverty, I would choose it just because of the freedom part of it. And but fortunately, we live in a society where God has created a consistent universe where freedom produces prosperity. And I know what you're saying. This was a lower standard of living relative to what we live today. But in terms of the freedom principles, Richard, it's an incredible period of time.
Well, I think that the point of comparison is not simply the one I was trying to be sarcastic about, is that, the outhouse, the horse poop on the streets, which is true. What enabled us to escape from that? And what enabled us to escape from that was the Thomas Edisons and the Henry Fords and those who invented indoor plumbing and not having to boil water to take a bath once a week because it was so inconvenient and difficult, but you could stand in an indoor shower with hot water coming right through the pipes for the convenience and amenities. In fact, I once saw an advertisement in an old National Geographic magazine from like about 1905 or 1910, and it was the silhouette of someone behind a shower curtain, and it said, "The shower in your home, safe and hygienic." Well, there's this new fangled contraption, Mildred, and I think we should invest in having it in our house. You stand in a box and the water falls right straight on your head. By golly, this is clearly about as far as we can go. But what has enabled us to escape from that? The rising standards of living, the improvement in the qualities, varieties, and new products is to the extent that markets were left alone for people to have the liberty and the latitude to innovatively and with genius and foresight to devise things that couldn't, in many cases, weren't even imaginable. That has made life easier and most convenient and better for all of us in little and big ways that we unfortunately take for granted too much.
Yeah, and I should have mentioned, I talked about all those things that we didn't have: immigration controls, income tax, Federal Reserve, et cetera. I should have mentioned the welfare state too. I mean, no Social Security, no Medicare, no Medicaid, no education grants, no farm subsidies, none of that, no foreign aid. And then, as you and I talked about in last week's Libertarian Angle, tremendous voluntary charity. I mean, that was when de Tocqueville came to America and said, my gosh, they've got charitable organizations for everything. Because when people were wealthy, the Henry Fords, the John D. Rockefellers, and so forth, turns out that they gave away a lot of their wealth to build the hospitals, the museums, the opera houses, and helped out people get educations and so forth. So really, I mean, I guess the bottom line of all this is that the state does a horrible job in all of these areas: monetary policy, helping the poor, the war on poverty, the war on wealth, foreign policy. The real answer to all this is the free market, economic liberty, especially in terms of monetary policy.
Yeah, the biggest difficulty friends of freedom have is getting people to overcome what has become their default position. If there's any inconvenience, dislikable thing, hardship, irritant in the society, the first presumption is to call upon the state. The idea of finding ways to handle this yourself, or them generating profitable market solutions, or even turning to your fellow citizens to creatively, in the circumstances that you know best, to devise charitable and mutually associative arrangements to do this voluntarily. That needs to be reawakened, people, because the state will continue to fail no matter how many times we turn to it to solve our problems.
All right. On that eloquent and insightful note, we'll wrap things up. If you're new to FFF, come and visit us at FFF.org. For 34 years of these types of commentaries, we've got both printed articles, we've got videos, we got conferences, and so forth. And Richard, as always, I greatly enjoyed the conversation, and I look forward to talking to you next week.
Until next time.